Welcome to Chapter 5 of Starting a Successful Small Business, a course by Gary Johnson. Listen to the recording now and follow along with your book, or listen now and go to your book later for further reinforcement of the details. Let's join Gary now as he presents Chapter 5, Business Details.
Chapter 5, Business Details. Deciding on the legal structure of your business. There are many reasons today for owner-managers of businesses to look at the legal structure of their firms. The changing tax laws and fluctuating availability of capital are just two situations which require alert owners to review what legal structures best meets their needs. Each form of business organization has its advantages and disadvantages. This section seeks to briefly identify them for the owner-manager who wants to know what questions to ask when seeking the proper professional advice. There are four basic kinds of business structures: the sole proprietorship, the partnership, the corporation, and the limited liability company. Each has certain general advantages and disadvantages, but they must all be weighed to reflect your specific circumstances, goals, and needs. The sole proprietorship. Sole proprietorship is the simplest form of business entity. If you choose this legal structure, then legally speaking, you and the business are one and the same. Establishing a sole proprietorship is cheap and relatively uncomplicated. While you do not have to file articles of incorporation or articles of organization as you would for a corporation or LLC, you may have to obtain a business license to do business under state laws or local ordinances. States differ on the amount of licensing required. Most states do require a sales tax license or permit for all retail businesses. Dealing with these routine licensing requirements generally involves little time or expense. Many specialized businesses, such as an asbestos removal service or a restaurant that serves liquor, require additional licenses which may be harder to qualify for. In addition, if you're going to conduct your business under a trade name, such as Smith Furniture Store rather than John Smith, you'll have to file an assumed name or fictitious name certificate at a local or state public office. This is so people who deal with your business will know who the real owner is. From an income tax standpoint, a sole proprietorship and its owner are treated as a single entity. Business income and losses are reported on your federal tax return, Form 1040 Schedule C. If you have a business loss, you may be able to use it to offset income that you receive from other sources. Advantages of the sole proprietorship: ease of formation. There is less formality and fewer legal restrictions associated with establishing a sole proprietorship. Sole ownership of profits. The proprietor is not required to share profits with anyone. Control and decision-making is vested in one owner. There are no co-owners or partners to consult with, except possibly your spouse. Flexibility. Management is able to respond quickly to business needs in the form of day-to-day management decisions. And last, relative freedom from government control and special taxation. Disadvantages of the sole proprietorship. Number one, unlimited liability. The individual proprietor is responsible for the full amount of business debts which may exceed the proprietor's total investment. This liability extends to all the proprietor's assets, such as house and car. Additional problems of liability, such as physical loss or personal injury, may be lessened by obtaining proper insurance coverage. Number two, unstable business life. The enterprise may be crippled or terminated upon the illness or death of the owner. Number three, less available capital than in other types of business organizations. Number four, relatively difficult in obtaining long-term finances. And number five, relatively limited viewpoint and experience. This is more often the case with one owner than with several. Note, a small business owner might very well select the sole proprietorship to begin with. Later, if the owner succeeds and has the need, he or she can form a corporation or limited liability company. Next, the partnership. The Uniform Partnership Act, adopted by many states, defines a partnership as an association of two or more persons to carry on as co-owners of a business for profit. Though not specifically required by the Act, written articles of partnership are customarily prepared. These articles outline the contribution by the partners into the business, whether financial, material, or managerial, and generally outline the roles of the partners in the business relationship. There are two types of partnerships: general partnerships, and limited partnerships. A general partnership is created when two or more individuals agree to create a business and to jointly own the assets, profits, and losses. A limited partnership may be created only by following certain steps set out in each particular state statutes. The primary advantage of partnerships is that they can have more than one owner. The most important disadvantages is that the general partners are personally liable for the losses and other obligations of the business. Some of the characteristics that distinguish a partnership from other forms of business are limited life of the partnership, unlimited liability of at least one partner, co-ownership of assets, share of management skills and responsibilities, share in partnership profits. Some advantages of the partnership: ease of formation. Legal informalities and expenses are few compared with the requirements for creation of a corporation, unless you're creating a limited liability company or limited partnership. Direct rewards. Partners are motivated to apply their abilities by direct sharing of the profits. Growth and performance are facilitated. It is often possible to obtain more capital and a better range of skills in a partnership than in a sole proprietorship. Flexibility. A partnership may be relatively more flexible in the decision-making process than a corporation, but it may be less so than in a sole proprietorship. And last, relative freedom from government control and special taxation. Disadvantages of a partnership: unlimited liability of at least one partner. Insurance considerations such as those mentioned in the proprietorship section also apply here. Unstable life. Elimination of any partner constitutes automatic dissolution of the partnership. However, operation of the business can continue based on the right of survivorship and possible creation of a new partnership. Partnership insurance might be considered. Relative difficulty in obtaining large sums of capital. This is particularly true of long-term financing when compared to a corporation. However, by using individual partner assets, opportunities are probably greater than in a partnership. The firm is bound by the acts of just one partner, meaning that you can be held responsible for the acts of your partner in the name of the partnership. And last, difficulty of disposing of partnership interest. The buying out of a partner may be difficult unless specifically arranged for in the written agreement. The best way to form a partnership is to have an attorney draw up and sign a partnership agreement. The corporation. If you're concerned about limiting your personal liability for business debts, you want to consider organizing your business as either a limited liability company, LLC, or a corporation. Of course, there are many other reasons in addition to limited liability for considering these two business structures. This information deals primarily with small, privately owned corporations. We're assuming that all of the corporate stock is either owned by one person or a few people, and that the shareholders are actively involved in the management of the business, with a possible exception of friends and relatives who have provided seed money in exchange for their stock. Because there are many complexities involved in selling stock to the public, we won't discuss public corporations. The most important feature of a corporation is that legally it is a separate entity from the individuals who own or operate it. You may own all of the stock of your corporation, and you may be its only employee. But if you follow sensible organizational and operating procedures, you and your corporation are separate legal entities. All states have adopted legislation that permits a corporation to be formed by a single incorporator, meaning just you. All states permit a corporate board that has a single director, although the ability to set up a one-person board may depend upon the number of shareholders. In addition, many states have streamlined the procedures for operating a small corporation to permit decisions to be made quickly and without needless formalities. For example, in most states, shareholders and directors can take action by unanimous written consent than by holding formal meetings, and directors' meetings can be, in some cases, held by telephone. Formation of the corporation. Establishing a corporation involves the formation of a separate legal entity under the laws of a particular state. A certificate or articles of incorporation are generally required to be filed with the Secretary of State's office. In addition, annual reports and other technical requirements are generally needed. There are corporate service firms which can help with these filings. Additional corporate formalities include the need for a board of directors, corporate officers and agents, and an annual meeting of stockholders and directors. The advantages of the corporation. Limitation of the stockholder's liability to a fixed amount of investment. However, do not confuse corporate liability with appropriate liability insurance considerations. Ownership is readily transferable. Separate legal existence. Stability and relative permanence of existence. For example, in the case of illness, death, or other cause for loss of a principal, officer, owner, the corporation continues to do business. Easier securing of capital in large amounts and from many investors. Capital may be acquired through issuance of various stocks and long-term bonds. Delegated authority. Centralized control is secured when owners delegate authority to hired managers. The ability of the corporation to draw on the expertise and skills of more than one individual. Now, some disadvantages of the corporation. Activities are limited by the charter and by various laws within a state. Manipulation. Minority shareholders are sometimes exploited. There can be extensive government regulations and required local, state, and federal reports. Less incentive if a manager of the business does not share in the business profits. Of course, the expense of forming a corporation and the possibility of double taxation. Income tax on corporate net income and on individual salary and dividends. Subchapter S status. An S corporation is very similar to a regular corporation, except it has elected to be treated under the rules of the Subchapter S of the Internal Revenue Code. So long as the technical requirements of the code are met, an S corporation is not taxed at the entity level and thus does not suffer from double taxation. Adhering to all of the requirements of the code can, among other things, limit the types and numbers of owners of an S corporation. The limited liability company. The limited liability company, or LLC, is a form of business entity that combines the limited liability protection of a corporation and the simplicity and tax advantages of a partnership. It is a viable and practical alternative to forming your company as a traditional corporation. While state laws and federal regulations governing how LLCs will be taxed are evolving, recent developments have proved to be extremely favorable to small businesses. Most states have made it easier to form LLCs, and recent federal tax regulation changes have given LLCs increased flexibility. On page 5.8, that's chapter 5, page 8, there is a comparison of the legal entities: sole proprietorship, partnership, corporation, the special S Corp, and LLC. I would suggest you review each one of those before going too far ahead with your attorney and making a decision in determining what legal form you should be. Now, some reasons to operate as a business entity other than a sole proprietorship. What are the respective costs to start each form of business entity? State mandated filing fees are from $200 for a LLC or corporation to as much as $750 for limited partnerships. Attorney fees for preparation of the formation documents and operations will range from $600 for a corporation or LLC to $1,000 to $1,500 for a limited partnership. Because the limited partners have so little say and tax consequences must be considered, the partnership agreement is the most involved in the three business entity forms. Asset protection, limitation of liability. The business, when you've created a separate legal entity, is separate from the owner. The business may enter into contracts, and the business may conduct business in the name of the business and not the owner of the business. When a problem arises, such as a lawsuit, the business is the one sued, not the owner. Tax savings. Business income from sole proprietorship or a general partnership is taxable to the owner, and the owner is considered self-employed. The owner pays 15.3% in Social Security taxes on the earnings of their profit. An owner can realize a tax savings that will quickly pay for the cost of forming the business entity if they're able to form a Subchapter S corporation. Franchise taxes may be owed on corporations or LLCs as a fee for doing business in a particular state. There are additional tax issues that your accountant can address, such as passive losses, deductibility of losses, taxes on distribution, and risk limitations. Estate planning. Recently, there has been much discussion in Washington, D.C. about the so-called death tax and its effect on small businesses. If your business is worth more than $1.5 million and you leave it to your children, they will pay a very large tax, as much as 35% of $500,000. If you leave them a percentage of the business entity, the tax code discounts the value of the asset because of lack of marketability and lack of control of a limited partnership. In other words, giving your children an interest in your corporation or your limited liability company may help significantly reduce the estate taxes, if owed, upon the business passing from you to your children. And you have a co-owner. Relationships have a way of changing over time. Partners often have a falling out, including spouses. A business entity with a properly drawn operational document will address such contingencies, like a buy-sell agreement, and spell out what is to happen in certain instances. For example, a co-owner may want to retire from the business or may want to contribute far more time to the business than another. One co-owner may want to sell out to a third party. Well-drafted operational documents will address such issues as retirement, sales, irreconcilable differences, business valuation, sales and financing terms, and first rights of refusal. Without a written agreement which contemplates such issues, you may find yourself operating your business with a co-owner whom you do not know, or you may leave your family with a business which they cannot get rid of. On page 510 through 512, there is an example of two individuals who own a business, David and Jim. David has formed more than one business entity. He's formed a limited liability company, a limited partnership, and a corporation. Of course, this is going to be much more expensive, but he has essentially protected his assets from third parties, from someone suing him personally. And Jim is operating his business, the exact same thing as David, as a sole proprietorship. Please note that David, even though he has more costs and expenses to set these entities up, he has given himself a tremendous amount of protection that Jim cannot have. Choosing between a corporation and LLC. Perhaps you've concluded it would be advantageous to operate your small business through an entity that limits the personal liability of all the owners, even if following the strategy involves a bit more paperwork, complexity, and possible expense. You have probably narrowed your choice of entity to either the tried and true corporation or the LLC. Which is better? There's no answer to this question that applies to every business. Nevertheless, some general principles may be helpful. For small businesses, the relative simplicity and flexibility of the LLC often makes it a better choice. This is especially true if your business will hold property, such as real estate, that's likely to increase in value. That's because regular corporations, sometimes C corporations, may be subject to a double tax. By contrast, the LLC member owners avoid this double taxation because the business tax liabilities are passed through to them. The LLC itself does not pay a tax on its income. But an LLC isn't always the best choice. Occasionally, other factors will be present that may tip the balance towards a corporation. Such factors include you want to be a single member LLC, but you live in a state which requires 2 or more members. You'd like to provide extensive fringe benefits to owner employees. Often when you form a corporation, you expect to be both a shareholder, owner, and an employee. The corporation, for example, can hire you to serve as a chief executive officer and pay you a tax-deductible salary, which from a tax standpoint is far better in most instances than paying you dividends, which can't be deducted by the corporation as a business expense and therefore wind up being taxed twice, once at the corporate level and once at the personal level. But corporate employees don't just receive pay. Most also receive fringe benefits. These benefits can include the payment of health insurance premiums and direct reimbursement of medical expenses. The corporation can deduct the cost of these benefits, and they are not treated as taxable income to the employees. Having your own corporation pay for these fringe benefits and then deduct the cost as a business expense can be an attractive feature of doing business through a regular corporation. These opportunities for you to receive tax-favored fringe benefits are somewhat reduced if you do business as an LLC, or as an S-Corp may be extremely reduced. Also, a regular corporation may be able to offer simply better retirement benefits. And last, you may want to entice or keep employees by offering stock options and stock bonus incentives. Simply put, LLCs don't have stock. Corporations do. While it's possible to reward an employee by offering a membership interest in an LLC, the process is awkward and likely to be less attractive to employees. Therefore, if you plan to offer ownership in your business as an employee incentive, it makes sense to incorporate patents, trademarks, service marks, and copyrights. Some people confuse patents, copyrights, and trademarks. Although there may be some similarities among these kinds of intellectual property protection, they are different and serve different purposes. What is a patent? A patent for an invention is the grant of property right to the inventor issued by the Patent and Trademark Office. The term of a patent is 20 years from the date on which the application for the patent was filed in the United States, or, in some special cases, from the date an earlier related application was filed. U.S. patent grants are effective only within the U.S., U.S. territories, and U.S. possessions. The right conferred by the patent grant is, in the language of the statute and of the grant itself, the right to exclude others from making, using, offering for sale, or selling the invention in the United States, or importing the invention into the United States. What is a trademark or service mark? A trademark is a word, name, symbol, or device which is used in trade with goods to indicate the source of the goods and to distinguish them from the goods of others. A service mark is the same as a trademark, except that it identifies and distinguishes the source of a service rather than a product. The terms trademark and mark are commonly used to refer to both trademarks and service marks. Trademark rights may be used to prevent others from using a confusingly similar mark, but not to prevent others from making the same goods or from selling the same goods or services under a clearly different mark. Trademarks which are used in interstate or foreign commerce may be registered with the Patent and Trademark Office. What is a copyright? Copyright is a form of protection provided to the authors of original works of authorship, including literary, dramatic, musical, artistic, and certain other intellectual works, both published and unpublished. The 1976 Copyright Act generally gives the owner of copyright the exclusive right to reproduce the copyrighted work, to prepare derivative works, to distribute copies of the copyrighted work, to perform the copyrighted work publicly, or to display the copyrighted work publicly. Collectively known as intellectual property, patents, copyrights, and trademarks are the three primary types of intellectual property that your business is likely to encounter and own. All ideas begin in the category of public domain, which means they do not belong to a specific person. Anybody can use them as they see fit, be it to paint a picture, to start a new small business, or even invent the proverbial better mousetrap. Once these ideas are put to use, however, their owners have certain rights to protect against infringements from others. Therefore, before you put your products into public view, you need to be taking precaution against those trying to stake a claim on your territory. On page 5-15, we have a summary form of the differences, the cost, how long patents, copyright, trademarks are useful for, and a website if you want to do the research online. Patents. Under the United States Constitution and federal law, patent rights are granted to inventors so that they may have exclusive rights to their discovery. This discovery allows the patent holder to prevent others from making, using, selling, offering to sell, or importing the patented item. Once the patent expires, the public can then produce, sell, and use the patented item at will. The guidelines for patentability were discussed in the previous section, Can You Protect Your Ideal?, on page 2-24. That's chapter 2, page 24. If you have actual knowledge that you are infringing on a patent, you are liable for treble damages to the patent holder. This means that you have to pay 3 times whatever the patent holder lost due to your infringement. Copyrights. Unlike patent law, copyright law does not protect the underlying invention or ideal. Rather, it protects only the method or manner of expressing the ideal. What can be copyrighted? Literary works, musical works, dramatic works, choreographies or pantomimes, pictures, sculptures or paintings, motion pictures, videos or other audiovisual works, sound recordings, computer programs, architectural designs. Rights granted by copyrights. A holder of a copyright has the exclusive right to do and to authorize others to do the following: to reproduce the work, to prepare derivatives, make changes, to distribute copies, and to perform the work publicly. In case of sound recordings, to perform the work publicly by means of a digital audio transmission. It is illegal for anyone to violate these rights, but there are exceptions to these general rights. So remember that this only gives you a basic idea about what a copyright does and what it does not do. Creation of copyrights. Copyright protection exists as soon as the author or creator of copyrightable material creates the work. If an employee creates a copyrighted work as part of his employment, the employer, not the employee, is assumed to be the author, and all copyrights flow to the employer. Note that it is not necessary to give notice or register the work to create copyright protection, although it is recommended because it gives the creator additional rights and protections. Copyright notices. For works created after March 1st, 1989, the use of copyright notice is optional. However, using the word copyright or the familiar symbol of a C inside a circle, along with the author's name and the year of publication in a place where it can be found upon reasonable inspection, is highly recommended. Note, for computer programs, you'd want to put the copyright notice on the first screen of the program and in the manuals. Copyright registration. In general, copyright registration is a legal formality intended to make public record of the basic facts of a particular copyright. The advantages of registering your copyright are many, including registration establishes a public record. Before an infringement suit may be filed in court, registration is necessary for works of U.S. origin. If made before or within 5 years of publication, registration will establish evidence in court of the validity of the copyright. And if registration is made within 3 months after the publication of the work or prior to an infringement of the work, statutory damages and attorney fees will be available to the copyright owner in court actions. Registration allows the owner of the copyright to record the registration with the U.S. Customs Service for protection against the importation of infringing copies. For additional information, request publication number 563, How to Protect Your Intellectual Property Right from the U.S. Customs Service. Registration procedures can be found on Chapter 5, page 18, under Registration Procedures, which are done through the Library of Congress, Copyright Office in Washington, D.C. Trademark service marks. A trademark is any word, slogan, such as "it's the real thing," or a name like Microsoft, or a symbol, think of the Apple computer logo, or a device, things like the animated Pillsbury Doughboy, adopted and used by a manufacturer or merchant to identify his goods and to distinguish them from those manufactured or sold by others. Service marks are generally the same thing, except they are employed by service providers rather than manufacturers or merchants. Types of trademarks. Trademark can be a word, a symbol, or design used to identify and distinguish goods. Service marks, a word or design used in connection with the sale or advertising of services, not goods, identifying those services and distinguishing them from services of others. A certification mark, a mark used to certify that goods or services meet certain standards of quality or regulatory compliance. A collective mark, a mark used to identify members of an organization. Purpose of a trademark. Trademark protection is supposed to do two things: prevent deception. By allowing businesses to reserve names and trademark, this is supposed to protect consumers from mistake, confusion, or deception. The other reason the law allows businesses to reserve names and identifying marks is to allow businesses and owners to make an investment into their business's goodwill without fear of others profiting from it. Taxes. Significant tax savings are available to the home-based business owner in the form of deductions, credits, and depreciation allowances. The time, money, and energy you put into keeping good records and keeping current on tax laws will be worthwhile and ensure that you operate within the law. You will need to plan for income tax, Social Security. All self-employment persons must pay a federal self-employment tax, employees' taxes if you hire anyone, property tax on any business-related items, sales tax, and sometimes gross receipts or inventory tax, and excise or individual tax items, as well as franchise tax for those of you who are forming LLCs or corporations. The Internal Revenue Service supplies a number of free booklets and even some free workshops to give you details on specific obligations. These can be found on the IRS's website at www.irs.gov. The home office tax deductions. You may be able to take a tax deduction for the business use of your home or apartment. The deduction is available not only for a home office, but for other business uses as well, such as a workshop or studio at home. Keep in mind that whether or not you deduct expenses that relate specifically to your home, such as rent, utilities, insurance, and repairs, you can still take a deduction for regular business expenses, such as photocopies, stationery, paper clips, wages, travel, equipment, professional memberships, publications, and any, of course, out-of-pocket costs related to your business. In order to have a home office deduction, you must meet at least two requirements. One, you must use a part of your home exclusively for a trade or business and on a regular basis. Requirement number two, you must be able to show that you use your home as principal place of business, or you meet patients, clients, or customers at home, or use a separate structure on your property exclusively for business purposes. What's regular and exclusive use? The first requirement for taking deductions related to your home is the portion of the home must be used exclusively for business. The notion of regular use is a bit vague. The IRS says it means that you're using a part of your home for business on a continuing basis, not just for occasional or incidental business. A few hours a day on most days is probably enough to meet this test. Exclusive use means that you may use a portion of your home only for business. If you use a room of your home for your business and also for personal purposes, that does not meet the exclusive use test. Example, Brooke, a lawyer, uses a den in his home to write legal briefs and prepare contracts. He also uses the den for poker games and hosting a book club. Result, technically, Brooke can't claim business deductions for using the den. Number two, it must not only be regular and exclusive use of the area, but it must also be principal place of business. In addition to using part of your home regularly and exclusively for business, to take deductions relating to your home, this must be your principal place of business or meet an exception. Establishing that your home is the principal place for business is simple if you conduct your business only from home. If you have more than one business location, however, including your home, for a single trade or business, you must figure out if your home is your principal place of business for that enterprise. Your home qualifies as your principal place of business if you conduct the administrative or management activities of your business there and you have no other fixed location where you could conduct those activities. In other words, your home doesn't have to be the place where you generate most of your business income. It's enough that you regularly use it to do such things as keeping your books, scheduling appointments, doing research, and ordering supplies if you have no other location to do these. Storing inventory or product samples at home. If you sell retail or wholesale products and you store inventory or samples at home, you can deduct expenses for the business use of your home. There are two limitations, however. First, you won't qualify for the deduction if you have an office or other business location away from the home. And second, you have to store the products in a particular place, your garage or closet or bedroom. It's okay to use the storage space for other purposes as well, as long as you regularly use it for inventory or samples. Next, meeting clients or customers at home. If your home isn't your principal place of business, you may still be entitled to deduct expenses for business use of your home if you regularly use part of your home exclusively to meet with clients, customers, or patients. And number four, using a separate building for your business. If your home isn't your principal place of business and you don't meet clients or customers at home, you can deduct expenses for a separate freestanding structure that you use regularly and exclusively for your business. This might be a studio or a converted garage, for example. Ways to document your home office deduction. First, photograph your home office and draw a diagram showing the location of the office in your home. Have your business mail sent to your home. Use your home address on business cards and stationery. Get separate phone lines for the business. Have clients or customers visit your home office and keep a log. Keep track of the time you spend working at home. All right, so you've passed the test to have a home-based business or to use a portion of your home as a business deduction. Next, you would need to obtain home office deduction form number 8829 from the IRS and the instructions. Now, the form is a pain, it's long, and it does require some effort. But if you plan on taking the home office deduction, you must file it. You risk attracting the IRS's attention if you try and take the home office deduction without filing this form. On pages 525 and 26, we do show you how to calculate those deductions. On page 526, home office deduction recapture. After 1977, if you sell your home after deducting a portion of its cost under the home office deduction, which is depreciation, you will have to repay any amount of deduction for just the depreciation recaptured in the course of the sale of the home. This means that if you deducted $15,000 of your home's cost, that's not the expenses like rent and utilities and insurance, but just depreciation, you will owe tax on $15,000 if you sell it for a profit since you recaptured your depreciated amounts. Renters should always take the deduction for home office costs since they do not have to worry about recapture issues. Deductibility of other business operating expenses. In general, you may deduct in your business all reasonable, necessary, and ordinary expenses. What does that mean? This falls under Tax Code Internal Revenue Section 162. The tax code doesn't clearly define either ordinary or necessary. Instead, federal courts have tried to figure out what Congress intended and apply it to a particular set of facts. Ordinary has been held to mean normal, common, accepted under the circumstances by the business community. Necessary means appropriate and helpful. Taken together, ordinary and necessary refers to the purpose for which an expense is made. For instance, renting office space is necessary and ordinary for most business folks, but it is neither unless it is actually used in running an enterprise for profit. Example, Mr. Henry, an accountant, deducted his yacht expenses, contending that because the boat flew a pennant with the numbers 1040, it brought him professional recognition and clients. The matter ended up before the tax court. The court ruled that the yacht wasn't a normal business expense for a tax pro, so it wasn't ordinary or necessary. In short, the yacht expense was personal and thus non-deductible. Some other procedures you may want to take a look at in determining whether something is deductible. The laugh test. Tax pros frequently rely on the laugh test. Can you put down an expense for business without laughing and putting one over on the IRS? In the example above, the tax court laughed the accountant and his yacht out of the court. Large expenses. Because the IRS knows that people don't intentionally overpay for anything, amounts paid aren't usually questioned. However, IRS auditors sometimes object to expenditures deemed unreasonably large under the circumstances. For example, it might be reasonable for a multi-state apparel company to lease a jet for travel between manufacturing plants, but not for a corner deli owner to fly to New York to meet with her pickle supplier. Personal expenses. The number one concern of the IRS when auditing business deductions is whether purely personal expenditures are being claimed as business expenses. For instance, you can't deduct the cost of commuting to work because the tax code specifically says that this is a personal, not a business expense. The same applies with business credit cards for a vacation or cruising the beach in a company car. IRS auditors are ever watchful. Fortunately, you can often arrange your fares legally in a way that lets you derive considerable personal benefit and enjoyment from business expenditures. Note, be careful if you deal with relatives. An IRS auditor will look very intensively at payments to a family member or to another business in which your relatives have an ownership interest. In tax code language, these are termed related parties. An auditor may suspect that taxable products are being taken out of your business for direct or indirect personal benefit in the guise of deductible expenses. For example, paying your spouse's father who is in prison $5,000 as a consultant fee for your restaurant business would smell bad to an auditor. On the bottom of page 528 and through on page 529, we have a list of the more common tax obligations and forms that the owner of a small business should file. Make sure you review each and every one of those. Also, a word of caution. For those of you who are self-employed, you will need to look at paying quarterly estimated taxes. On page 529, we detail this, but just make sure you understand that the IRS system of collecting taxes is a pay-as-you-go. In other words, the IRS does not want you to file your tax return on April 15th and owe thousands of dollars in taxes in most instances. So they want you to pay your tax based upon a quarterly estimated taxes, which we detail on page 529 and 530. On page 530, we have a list of the IRS's website. We have a business tax kit. We have a phone number available both from the state of Texas, the Social Security Department, and the Internal Revenue Service. We suggest that you call or go online and get each of these reports specifically made available to your business. The Texas Workforce Commission collects all unemployment taxes for workers employed in Texas. For information regarding these taxes or to obtain a tax employer identification number, you can contact the Texas Workforce Commission, and we've given you the website on the middle of page 5-31. Finding outside consultants. There are three basic kinds of accountants who can help with your financial matters: bookkeepers, certified accountants, and certified public accountants. Bookkeepers, a bookkeeper maintains the record-keeping system once it has been set up. They may or may not have a degree in the accounting field. Usually their services and expertise is limited. A certified accountant is usually a licensed, certified, or registered accountant and will have a degree from a recognized institution and belong to various accounting associations and have met their requirements. This kind of accountant can advise you on ways to improve business transactions, cash flows, assist in the preparation of financial statements, annual tax returns and reports, help in developing compensation plans, and design an accounting system. Certified public accountants. Most businesses rely on the regular accountants and bookkeepers to meet their accounting needs. However, if your business has a legal form, a separate legal entity, such as a LLC or incorporation, we say it's necessary to get a certified public accountant or CPA to review your books. A certified public accountant meets and follows well-defined professional accounting standards. Their opinions are used by outside agencies, including banks and tax collection agencies, to make financial judgments about your company. This means that even though they are selected and paid for by your company, they really represent your company's shareholders and other outside agencies. Most specifically, a certified public accountant can review your company's financial data, audit your financial records, inspect and verify the correct preparation of your tax return, and set up an accounting system. How to pick a good accounting firm. When choosing an accounting firm, your decision will likely be based on one of the following three factors: whether you want to work with a large or small firm, what exactly will the role of the accounting firm be, and the qualifications of the accountants in the firm. The first factor an entrepreneur must consider when choosing an accounting firm is whether to use a major national accounting firm, a large regional, or a small firm with just one or two professionals. Big firms are likely to offer experience in more specialized areas of accounting. They also provide substantial financial credibility, which many new businesses may badly need. With a smaller firm, you're likely to get more attention, they're likely to be more responsive, and their hourly rates are probably much lower. The second factor an entrepreneur must consider when choosing an accounting firm is what role the accounting firm will take in your business. In general, the role of the accounting firm should not be to tell you what you should do and what you should not do. As a matter of principle, you should have a relationship in which you make the decisions and then they determine their acceptability. In the case of certified public accountants, when disagreements arise, If it is about the preparation of your accounting records for your business, they may have the final say-so. When disagreements arise, you may have no choice but to go with the public accountant's answer if you want to have an audited financial statement. Qualifications. The third factor an entrepreneur must consider when choosing an accounting firm is the individual qualifications of the accounting firm members. Some accountants will have professional degrees, others will not. All belong to associations which govern conduct and keep members informed of developments within the industry. How to get the most out of your accountant. Most accountants don't want to do bookkeeping because they do not have the staff nor the time to make monotonous entries. Although they will do it if necessary, you will bill based on the time they spend on your account. And that rate is the same whether they're doing financial statement or day-to-day bookkeeping. For those reasons, it will pay you to do as much of the preliminary work as you can. In fact, most accountants will actually prefer you to do the bookkeeping and allow them to get on the highly skilled business of preparing financial statements and tax planning. A conference with your accountant will outline the types of records that he or she wants you to keep and how they should be maintained. Lawyers. Every entrepreneur will at one time or another need the services of a lawyer. Lawyers are necessary to help you set up a corporation, organize your business, advise you on securities and stock regulations. They can assist you in negotiations, oversee large capital purchases, especially real estate, prepare or review various contracts, counsel you on how to handle sensitive employee issues, offer advice on patent and copyright issues, look ahead to anticipate any legal, leasing, or contractual problems. How to pick a good lawyer. Despite the fact that lawyers are often perceived to be money-hungry ambulance chasers, the majority of them tend to be conservative and more inclined to tell you why everything you want to do is not a good idea because of the risk involved. Stay away from those who lack the ability to get around these risks. Pick lawyers with vision, those who want to be able to untie the multitude of legal chains if necessary. Further, since law is a very complex field, most attorneys concentrate on narrow specialties. By all means, choose an attorney who specializes in business or tax laws rather than divorce or malpractice law. How to get the most out of your attorney. In most business situations, you should use your lawyer as much as possible to review your work. You should prepare the agreements or ask for additions and comments in many instances, rather than having a lawyer prepare the original agreement. Insurance. Insurance helps to safeguard your business against losses from fire, illness, and injury. You cannot operate without it. Talk with an insurance representative about your business needs. Check with the insurance competitors on your home policy and make sure business use of your home is compatible with your homeowner's policy. Now that you have a business, you'll need a commercial policy for full protection. Discuss these other possible needs with your agent. Home or partnership insurance usually doesn't cover liability for accidents or injuries to customers or business visitors. Partnership insurance to cover you against suits arising from the actions of any partners. Product liability coverage to protect you in case your product causes injury. Auto liability and non-owned auto liability insurance if a car is ever used to support the business in any way. Medical payments insurance, workers' compensation if you have employees, business interruption insurance, disability income protection, and business life insurance to provide funds for transition if you or a partner were to die. Dealing with laws, zoning, licensing, permits, and others. Zoning. Before you start your business, do a thorough investigation of the zoning laws in your community. Zoning regulations spell out activities permitted and prohibited in various portions of a city or county. Call your town hall, zoning office, or local library to get a copy of the zoning laws. If the home business you're planning conforms to zoning regulations, then all you need to do is to keep abreast of new proposals that affect your situation. It's a good idea to stay in touch with others operating from their homes by joining business associations or organizations or neighborhood groups in case you ever need to band together to propose or oppose new regulations. If through your research you discover that the small business you're planning would violate the zoning codes, there are several possible ways to proceed. You might wish to check with an attorney who specializes in zoning law to look for a legal way around the regulation. You might decide to apply to the zoning board for a variance or exception. Or you may be able to change your business enough to make the operation fit the law. If the unfortunate and unlikely event that you are issued a cease and desist order, you should file an appeal immediately with the appeals board, submit a change in the regulation to the zoning board to allow your business, which may enable you to continue to operate without fines until the board reaches a decision. You may need a lawyer if you are not entirely familiar with the regulations and the workings of the zoning board. There are two ways to keep up with zoning legislation in your community. One way is to read local newspapers, especially the business section and the local or neighborhood sections. Be sure you notice local items about such things as proposed subway stations or other plan for revitalization. The other way is to join the local chapter of a business group such as a Rotary Club, the National Association of Women Business Owners, a National Family Business Council, or a business or professional men or women's club. Licensing and permits. On page 5-39 through about 5-40, we have listed some websites that you can go look at to determine the license and permits. At the bottom of page 539, there's a website, www.tded.state.tx.us/guide/. This is the site for the Texas Economic Development, and it will walk you through all of the license and permits listed for your business. Regulations for consumer protection. In addition to licenses we have referred to earlier, laws and regulations are also designed for consumer protection. Some may affect your business practices. For example, the Consumer Credit Protection Act has become the law of the land. This is commonly known as the truth in lending. If you extend credit to your customers, you must make a meaningful disclosure of credit terms and prescribed standard terminology so consumers may compare more readily the various credit terms available to them. Laws protecting the environment. Laws encouraging competition. Some business practices are prohibited or restricted by legislation to encourage competition. Federal laws govern interstate commerce, while state legislation regulates intrastate transaction. From time to time, these statutes are amended and new interpretations are made by the courts. Your lawyer, chamber of commerce, or business association can tell you how such laws may affect you. OSHA. We've given you a website on page 5-41. Be aware also of the Occupational Safety and Health Act. This law makes each employer responsible for furnishing employees places of employment free from recognized hazards causing or likely to cause death or serious physical harm. The employer must comply with safety and health standards underneath this act. Permits. On page 541, we've listed a guide to those various permits and a website where you can get each one of those. On page 547, we deal with Americans with Disabilities Act. Americans with Disability Act provides protection for people with disabilities in the areas of employment, public service, transportation, public accommodation, and telecommunications. You can go to the U.S. Equal Employment Opportunity Commission's website, www.eeoc.gov. Finding and keeping great employees. A business is only as good as the people in it, including yourself as well as your employees. Therefore, to effectively manage your business, you must take the time to find and hire, if you need them, the right employees. This guide, in the last few pages of Chapter 5, deals with the process of staffing a business, setting the personnel policies, determining what skill and abilities are needed, finding applicants, developing application forms, and interviewing prospective employees. Staffing is of critical importance to businesses of all shapes and sizes. All firms take the same risk in hiring a new employee. However, the smaller firm, the less it is able to afford the time and costs involved in hiring and then firing the wrong employee. John D. Rockefeller said, "I will pay more for the ability to deal with people than for any other ability under the sun." Getting the work done. An important step in setting up your business is to find and hire capable employees. Then you must train them to work together to get the job done. Obviously, organization is needed if your business is to produce what you expect to produce, namely profits. Organization is essential because you, as the owner-manager, cannot do all the work. As your organization grows, you have to delegate work, responsibility, and authority. A helpful tool in getting this done is the organization chart. It shows at a glance who is responsible for the major activities of a business. As an additional aid in determining both what needs to be done and who will do it, list each activity that is involved in your business. Next to the activity, indicate who will do it. You may do this by name or some other designation such as worker number 1. Remember that a name may appear more than once. Developing a personnel system, assessing personnel needs. The most important of these principles are all positions should be filled with people who are both willing and able to do the job. The more accurate and realistic the specifications of the skill requirements for each job, the more likely it is that the workers will be matched to the right job and therefore be more competent. A written job description and definition are the keys to communicating good job expectations to people. Do the best job you can is a terrible job guidance. Employees chosen on the basis of the best person available are more effective than those chosen on the basis of friendship or expediency. If specific job expectations are clearly spelled out, and if performance appraisals are based on those expectations, performance is higher. The first step in assessing personnel needs for the small business is to conduct an audit of future personnel needs. Ask yourself, can the workload you visualized be accomplished with the present workforce? Will more or fewer employees be needed? Can any jobs be eliminated to free people of other work? What balance of full-time, part-time, temporary, permanent, hourly, or salary personnel do you need? What does the labor supply look like in the future? Will you be able to fill some of the jobs you've identified? How easily? What qualifications are needed in your personnel? Job analysis and description. The first step in analyzing a job is to describe it. Job analysis is a systematic investigation that collects all information pertinent to each task performed by an employee. From this analysis, you identify the skills, knowledge, and abilities required of that employee and determine the duties, responsibilities, and requirements of each job. Suppose, as a business owner-manager, you decide to hire someone to relieve you of some of your duties. Look at the many functions you perform and decide what your stronger and weaker areas are. Further, suppose that you have decided that you will need help in the office. The phone is always ringing. Letters which need answering are piling up. Merchandise must be ordered. Once you have a job description on paper, decide what skills the person must have to fill the job. What is the lowest level of skill you will accept? In this example, let us assume that you decide initially to hire a secretary, but discover that secretaries are scarce and expensive. In your area, stenographers are almost as hard to find and nearly as expensive as secretaries. Perhaps you could get by with a typist. Hiring a typist might be both easier and cheaper than hiring a secretary. Many high school students are well qualified as typists, and many are seeking part-time work. One additional point, when you start to look for someone to fill your job, make sure you spell out what you want. Imagine that an owner-manager advertised for a sales clerk. What should the applicant be able to do? Just tally sales receipts accurately, keep a customer list, and occasionally promote your products to other people, run the store while you're away? The job of sales clerks means different things to different people. Make sure you know what skills you need and what skills you can get by with. The job analysis is used to generate a job description, which defines the duties of each task and other responsibilities of the position. Sources of employees. Where can we get our employees? Several places. Present employees. Promotion from within tends to keep employee morale high. Unsolicited applicants. Small businesses receive many unsolicited applications from qualified and unqualified individuals. The former should be kept on file for future reference. Schools, high schools, trade schools, vocational schools, college and universities are sources for certain types of employees. Each state has an unemployment service. For Texas, it's the Texas Workforce Commission, and we've already given you the website. All are affiliated with the United States Employment Service, and local offices are ready to help businesses with hiring problems. Private employment agencies. These firms provide a service for employees and applicants by matching people to jobs in exchange for a fee. Employee referrals. References by current employees may provide excellent prospects for the business. Help wanting. Letting people know that the business is hiring is a key element. At its simple, this type of advertising may take the form of a help wanted sign in the window. In addition, today we have things like Monster.com and other online services, that some of which are free and some of which are not, that can be great sources of going through a large number of applicants in a short period of time. Screening. The screening process of employees provides information about an individual's skills, knowledge, and attitudes. The application form, which we've listed at the end of Chapter 5, is a tool which you can use to make your task of interviewing and selection easier. This form should have blank spaces for all the facts. A sample form, again, is provided at the end of this chapter. You'll want a fairly complete application so you can get sufficient information. However, keep the form as simple as possible. You may want to use an application form that's more specific to your particular industry. How would we get that? By going to the trade association that we can be a member of and asking them for their application form for a particular job position. The personal interview is the second step in the screening process. During the interview, the manager learns about the applicant through a face-to-face contact. As you go along, evaluate the applicant's replies. Do they know what they're talking about? Are they evasive or unskilled in the job test? Can they account for discrepancies between what they've said in the interview and what's in the job application? 3 major errors often committed in the personal interview are failure to analyze the requirements of the job in sufficient detail to generate valid questions, failure to ask candidates the right questions to determine their strengths and weaknesses and their fit with the job, and too much reliance on gut reaction instead of objective evaluation of candidates based on the criteria established in the job specifications. Selecting and hiring. If the screening process is thorough, selecting the best applicants for the job is easy. However, before making the final decision, one last step should be taken. The top candidate's reference should be checked for accuracy and input. You should be aware of the tendency of references to give rose-colored picture of applicants' character and ability. Despite this potential bias, a careful check with former employees, schools, and other references can be most constructive. In addition to that, if you're hiring an individual for a sensitive position in your company, then it may also be necessary that you have a criminal background check performed on each employee. Orienting new employees to your business. An employee handbook communicates important information about the company to the employee. The handbook should cover topics such as company expectations, pay policies, working conditions, fringe benefits, and the company philosophy towards customers. Compensation issues. 2 types of compensation. Direct compensation. Wages and salaries are the compensation people receive on a regular basis, monthly, bi-weekly, or weekly. Workers are paid on the basis of time or the basis of output. Indirect compensation. Fringe benefits are an important part of the overall compensation package for many small businesses. Employee benefits, believe it or not, now account for 40% of payroll costs. The profitability of the small firm is one of the primary determinants of what benefits are offered by the firm. For example, a young employee with several small children may be interested in dental insurance for his family. He is not really interested in or motivated by a pension plan at this time in his life. Another employee in the same company is in his or her late 40s, has no dependent children, and is planning for retirement. To force the same benefits on these 2 employees is not an effective use of benefit money. Small businesses face difficult challenges when they try to match big benefits with big firms. Nevertheless, the small firm can enjoy the benefits of greater flexibility and innovativeness by offering a cafeteria plan available through many insurance companies, sometimes called a flexible fringe benefit plan. Setting personnel policies. Make sure that you have a consistent policy that deals with the hours of your firm, the fringe benefits, vacations, time off, training, grievances, promotions, personnel review, and even termination.
This concludes Chapter 5, Business Details. Use this recording and these materials as much as possible until you thoroughly understand how to start a successful small business.